What's up guys, Bill here. In this video I'm going to talk about my favorite swing setup, what I call PEG flags. PEG is short for power earnings gap. If you're new to the channel and you're not really sure what a power earnings gap is, I will provide a link at the end of this video to another video I did on that subject that you can check out. But in a really short summary, a power earnings gap happens when a stock has earnings gaps up majorly, ideally 10% or more, and on volume that's massive, ideally at least the most volume it's had since its last earnings or its last quarter, right? But the higher the volume, the better, the bigger the breakout, the better. And we'd like to see that candle on the day it gaps up close nice and green, nearer the highs, the better. Okay. So this first example is PYPL. We can see here the big earnings gap up of 23% on super high volume, the highest volume it had had in a year, and closing really nice and green towards the top of the day, high of the day. And that's what you want to see for a PEG. Now, the flag part, okay, if it's not obvious, we want to see over the coming days and weeks this stock start to kind of slow down, consolidate, and flag. Now, this one kept going for a few days. That's going to happen. Sometimes they put in a nice candle like this and they start to slowly pull back. Either way, what we're looking for is some type of consolidation, flagging, a wedge forming on decreasing volume. As the EMAs, the shorter term EMAs, I prefer the 9 and 20, but you know, the 10, the 21, whatever, there's not a huge difference, whatever you use. These start to catch up to price, and price starts to consolidate, and the range decreases and the volume decreases. And that's where we're going to want to take our entry somewhere near these 9 and 20 EMAs, right? So you can see on this stock, that's exactly what happens. It's really strong. It has a couple more nice days of gains, and then it slowly starts to consolidate and flag, and the volume is decreasing, right? Until we get to the point where this 9 EMA catches up. We've got some really tight range days on really low volume, and this would be a great place to consider an entry, okay? So what I'm going to do the rest of this video is show a bunch of different examples where things kind of happen a little differently, and talk about some nuances of the setup in some ways, some different types of ways to execute it, when you can take entries in different ways, because no setup is just, you always do this exactly this way every time. That would be perfect, a perfect world, right? But the market isn't like that. The market's way more challenging than that. And it requires you to think a little bit more deeply about your setups, and add nuance and tailor fit them to you and your personality, and also the different market environments. Not every time that this PEG flag occurs, you know, next quarter might be totally different market environment than this current quarter, right? A year from now could be totally different than right now. So we're always trying to find nuance. We're always trying to customize and better fit these setups to our current trading situation, all right? So here's just one kind of very general setup. And you can see that this first entry at the 9 gets a nice run up, and then eventually it comes down, it loses the 9, and it tests the 20 for the first time, and then gets another leg. These 9 and 20 work very well in conjunction together, and where you're deciding to get in for the first time is going to come down to a couple things. One, just aggression level, right? If you start in at the 9 and you say to yourself, the 20 is my risk, okay? And there's a pretty big gap here from the 9 to the 20. So you have to enter here being willing to take a bit of a drawdown and see if price will hold this 20, right? It also can come down to the market environment. Sometimes you get your first test of the 9 here on this stock, but maybe SPY is super extended to the upside from the 9. And that means that the broader market likely needs to pull back and digest a little bit. So maybe this stock, even though it had nice relative strength, is going to have a less high probability of holding this initial test. And you may want to wait to the 20, right? So there's mitigating factors here at play besides just having tunnel vision on one stock at one time, all right? But let's look at some other examples. And going back to the 9 and 20, I feel like the 20 is more reliable and it's going to hold more often than the 9, but there's certain times where you're going to want to hop in at the 9, right? And it's just going to come down to your aggression level, how much you like the setup, and what your current market environment is. Here's AFRM, all right? Another way I like to enter these peg flags is on inside days once the EMAs have caught up, and this is a great example of that. We get the big gap up, 32%. On massive volume. It has one more nice day, and then it starts to pull back. But as we see, even though it's all these red days in a row, someone might look at this chart and say, oh man, it's just so many red days in a row, and it might scare them away. But we look at the volume drop, right? And then we get an inside day here on the lowest volume since it gapped up, and really the lowest volume it had in several weeks, right? I traded this one personally. That's where I got my entry. We did get a little bit more of a pullback here, but we hammered, buyer stepped in. Now, a great thing about looking for entries on these setups is trying to find confluence near the EMAs. So other levels that are around your 9 or around your 20 are great ways to feel better about the entry. In this instance, right below the 9, we had the peg day low. That's a very good level. And as we can see, it pretty much held that next day, even though in this very specific instance on this trade, there was negative news this day by a CEO talking about consumer credit, and it really led to a harsh sell-off off the open on pretty much every fintech name. So like Affirm, Upstart, Hood, so many of them, right? They all sold off hard, in the morning, but were bought back up. And as we can see, the next day, we're starting to form this falling wedge. I was already in here. We get the big pop, right? The next day, of an 8% move. And then it just never really looked back all the way to 48. Just touched that 9 the next day, kept going, gapped up, a little more consolidation, and boom, a big breakout to 48. And it's still trading above the 9, right? So it hasn't really even touched the 20 yet, but that 20 was a nice buffer there. So this one still has a lot of life left. I still have contracts left in this swing. Up here, they were 500% on the October monthly contracts from my entry here. Okay, so that's a great look there. The inside days on super low volume, once the EMAs catch up, is a great place to enter. And you can enter right before the close because you can look at your daily charts and say, okay, this is going to be an inside day tomorrow. This 9 is caught up. Look at how low the volume is. I'm going to grab some contracts now because a lot of times off this type of setup, you'll actually get this type of move the next day. But there was bad news this day, like I said. So, context matters. I'm trying to provide as much of it as possible. Docs. This is a great example of what I call the volume dry up entry. It's very similar to what we just saw on Affirm, except it's not technically an inside day. Okay. So we get the big gap up, 38% on tons of volume. And this one starts to flag immediately. But it's still extended from the 9 here. So there's really no entry yet. Here's where the 9 catches up the first time. Again, if you want to be very aggressive, you could hop in here. I wouldn't fault that, but make sure you check the distance between your 9 and your 20, because more often than not, that 20 is going to be our risk, because it's very reliable, especially if there's support confluence around it. Okay. Just make sure you're okay with, potentially having the stock pull like this, and all of a sudden you're down here and waiting for, to see if there's support. Make sure, you can accept that amount of risk and that you view the potential move that the stock can make worth it, right? If it's a couple dollar pull, but you kind of think, oh man, it only looks like maybe we could get to this level up here and that's only a couple dollars away, then your risk to reward is basically 1-to-1. That's not great. I'm always looking for minimum 2-to-1, preferably 3-to-1. And that's something you need to assess before you take your entry, right? So maybe here you say, well, 40 is a great target, and that's about $3.50 away. But if we pull down here, 36.50 down to 34-ish, that's $2.50. It's about 1-to-1 risk to reward. I'm going to wait a little more and maybe it'll pull back to the 20, right? Okay. So it kind of does. It tests the 9 a couple days and then eventually it closes below. And then here's the day that interests me the most, right? Look at how much the volume dries up. I mean, it's almost non-existent volume at this point. This is where I entered on this stock, okay? And then at this point, I'm a little bit closer to the 20 than we would have been up here, right? So I've improved my risk to reward a little bit. I've seen that volume dry up so much. And it just gives me, this is what an entry I prefer, right? A little doji candle on super tiny volume. And we see within a few days, it's reclaiming the 9. And then eventually you get your big breakout. And here comes the volume again. And that's what you want to see. When you're in a long period of a flag, a consolidation, sideways action, and you finally get a nice, obvious push day, you want to see that volume come back in. That's going to give you confidence that the move can keep going. And it does. It goes for a few more days, right? And we've hit, the 4-day target, and we've made new 52-week highs and all that good stuff. And it's just a nice trade. And we still haven't tested the 20, and these are still working, right? So there's no reason to sell here as we hold these EMAs. Just forming another flag. Ideally, this 9 catches up, and we get even another leg, on this, play. And that's where it is. And if, at this point, when you have a nice cushion, you can, trail a stop. You can set a break-even stop on a small size of the rest of your position, whatever you're holding left. You can wait to see if it actually does lose the 9 or the 20. I mean, it's up to you at that point. Again, all these types of decisions, these are the nuances that every trader kind of has to decide for themselves what works best for their personality and their strategy and their trading goals, okay? Let's look at another example. This is a good one where we see some confluence of support by the 20, okay? So we get this peg set up, and it has a nice several-day run after the peg, and it busts through this pesky resistance that it had going back a few months before. And eventually it rolls over, and here's the first 9 test. And again, can you enter on the first 9 tests? Sure, sometimes I do. I didn't in this case because why? I mean, look at how big of a gap there is between the 20 and also, and more important, I look at the 20 and I say, ooh, look at that confluence with that previous resistance. A nice retest of that previous resistance will line up roughly with that 20, and that's a great place to risk off of, right? One of the biggest parts of these trades and why I like them is because when you're getting in closer to these EMAs, especially the 20 with confluence, it's so low risk, right? I mean, the worst thing happens is you get in here and it's a nasty day of selling and you're down a couple % on the stock, on commons, or you're down maybe 30-40% on some longer dated options. It's not the end of the world. And as we saw with AFRM, those contracts ran 500% and I'm still in. You're easily going to make up several losses, controlled losses, with one really nice win on these type of trades, because you're getting in such a tight risk and you're entering something that has just blasted out of earnings. Everyone's loving it. There's institutional buying, there's retail buying, and you've waited till everything's calmed down and the dust is settled and the volume's dried up and people are maybe kind of sleeping on it again, and you're getting in for that next leg higher with very low risk. All right. That's why I love these setups. So you can see here the price comes down and it starts chopping for several days, but it never loses that previous resistance, becoming support test. And yeah, it closes just below the 20, but it never really loses it in a meaningful way. And that's another thing I want to talk about, guys. Let's look at Z. We need to use a little bit of flexibility around the 20 EMA. Okay, so we gap up, it's respecting the 9, you get a nice bounce initially, it loses the 9, here's the 20, okay, so maybe you're getting in around the 20, or you're in on the 9 and you say, the 20 is my stop loss. Well, it closes below here, right? But it barely does, and it does it on low relative volume. I usually try to be a little patient on the first close below the 20, if it's not, extended, like if it closes down here, then yes, I'm going to cut. If it closes down here and it's really high volume, then yes, I'm going to cut. But the 20 EMA is not a secret, okay? Everyone knows about the 20 EMA. It's very popular. It's a very popular place to risk off of and trail risk on winners. Big money knows this. And the people that can actually move the market, if they want to raid stops and they want to grab liquidity on a stock that's strong and respecting the moving averages, what are they going to do? They're going to shove it below for a day or two and then bring it back, shake everybody out, bring it back and rip it. Okay. We see it all the time. And that's kind of what they did here. And then what happens the very next day? You reclaim the EMA and then a really nice push 4% day, and it never looks back. Okay. So a little nuance on the 20, it closes 5 cents below doesn't mean you instantly have to stop out. Does it close below extended? Does it close below on high volume? Then maybe, yes, we should stop out. But using a little bit of nuance here and flexibility on your stop allows you to stay in the majority of these trades and make the moves that you're intended to make. There's nothing worse than stopping out, selling the bottom, and looking around 2 days later or 3 days, a week later, and the stock's up 30% from where you stopped out. Okay. That is the worst. And then one last example, guys, a couple little nuance things, a couple good things to learn. All right. Here's PayPal. We get a peg, but then in 2 days later, we're right back to the EMAs. You do not want to see this, right? We want those slow pullbacks, right? Those controlled, low volume, several day pullbacks. All right. The long flag on decreasing volume. We do not want 2 days of selling wiping out the entire earnings gap. Okay. You buy this 9 EMA, and you're gapping all the way down to here at one point, right? That's tough. You're probably going to get stopped. Now buyers, step in, there's a big hammer candle. And then what happens the next day? They reclaim the EMAs. A loss and reclaim of the EMAs, if you never took entry on an initial test, is also a good place to give it a shot. Okay. This is like we just talked about on Z, where big money will like to shove something down back below the EMAs, stop everybody out, reclaim them and rip it. This is kind of what happened on PayPal too, but very aggressively and in just a couple days of action, right? So the reclaim of the level can be a great entry. And this is another nice example later on. Once we reclaim and PayPal makes a great move, it surfs up this 9, it puts in another gap up, and then it starts to flag in a more controlled manner. Test the 9 for the first time. Nice little, move off that, but nothing crazy. And then it loses the 9 and the 20. But what's it got going on here? Very similar to what we saw in SE. This major previous resistance now becoming support. So even though we've lost the 20, and yeah, we're dipping a little bit lower than below the 20 than maybe you'll want to see on an average name. What do we have? We have that support confluence. So if you miss the reclaim and you're kind of waiting and maybe you want to get in at the 9 here, you're thinking about that. You look and you see, oh man, just below this 20, we have this major support resistance flip that could occur here. Maybe I'll be patient and I'll wait till we get in at the 20. So you get at the 20, you give yourself, $69.50, you give yourself $1.50 risk or so, of holding this level. And look, price buyers step in each time, wicking below, closing back over, and then ripping it right up, close to, 80, right? You can give yourself $1 risk to reward and say, I'm going to target, this weekly level up here on PayPal, this big weekly pivot. That's awesome risk to reward. Okay. And that's what these setups are all about. Very tight risk, low risk with big reward on stocks that have just beat earnings, had great reactions, have a lot of interest, buyers, both in institutions and retail. That's how I play these guys, peg flags. Hopefully that helps. If you have any questions about this setup, just leave a comment or find me on Twitter and I'll help you out. If you're new to the channel, please like and subscribe if you'd like to see more content like this in the future. I'd really appreciate it.